going on YouTube? I'm Mike with Penner Investments, and today I'm going to talk about buying call options before earnings. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. Alright, let's dive in. I wanted to talk about this strategy as this is a little harder way to make money as compared to selling options, which selling options is my favorite strategy utilizing the wheel strategy. Buying a call option, you have to be right on the direction, meaning it has to be a decent move in the stock, and your timing has to be right as well. Last week I knew Nvidia was having their earnings release, and I thought it would be a big move up as Nvidia is one of the top chip makers in the world and is also a big player in artificial intelligence. On top of being a top performing company, I always like to look at what the analysts are predicting for the company when the company releases their earnings. An earnings surprise to the upside can easily cause the stock to take off, and this is where it pays off to have some call options on the table. On Yahoo Finance, I like to click on the Analysis tab and scroll down to see what the professionals that follow the stock are thinking for earnings per share estimate. What I'm looking for here is their estimate for the past 90, 60, 30 days, and are trending. I want to make sure all of these are trending up. Last quarter before the earnings was released, it did show a steady increase, and that was the final factor that made me decide to buy a call option. You can see here on the following quarter coming up, the last 7 days it has dipped down. If that was the case, I would not do the trade. But last quarter it showed a steady increase, so I purchased one call option at the 7:15 strike that expired on March 8th, and this cost me $6,180. This gave me a couple weeks to expiration after earnings, and the call option was slightly in the money when I purchased it. Unfortunately, several days before the earnings released, Nvidia dropped down a few percent each day all the way up until they released earnings. I believe the market was starting to doubt the company could deliver another over-the-top quarter. Fortunately, my prediction was correct, and the company did beat earnings following the following day, and the stock did start to take back off. I just happened to have bad timing on buying the call option several days before earnings, as the stock had kind of dropped down 2 to 3% each day all the way up to earnings. Since the stock had dropped down several percent day after day before the earnings, when it popped up the next day, a big portion of the move was recovering from what it had already dropped off leading up to earnings. On the open of the market, even though my prediction and direction was correct on the stock, my call option was still in the negative. After an hour from the market being open, it finally turned into the green, and I was able to exit the trade for a small gain. If I'd given it another hour, it was going to be worth maybe a couple grand more. Not the big win I was hoping for, but I just wanted to go ahead and get out of the trade and not lock in a loss. For a directional trade like this, you can see a lot of things have to line up for it to be profitable. This is why 99% of my trades are selling put options, doing covered calls, and mixing in a few credit spreads instead of buying options. As always, if there's ever anything you'd like me to discuss further, drop a comment in the box below. Thanks for watching, and good luck trading.